There are several types of business loans available to small businesses, each designed to meet different needs. Here's a detailed overview of the most common types. 1. Term loans. Description: a lump sum of money that you repay over a fixed period with interest. Best for businesses looking to expand, purchase equipment, or cover large expenses. Pros: fixed monthly payments, predictable costs. Cons: may require good credit and collateral. 2. SBA loans. Description: loans guaranteed by the U.S. Small Business Administration (SBA), reducing the risk for lenders. Types: SBA 7A loans, up to $5 million for working capital, expansion, or purchasing an existing business. SBA 504 loans, up to $5 million for purchasing fixed assets like real estate or equipment. SBA microloans, up to $50,000 for working capital, inventory, or equipment. Pros: lower interest rates, longer repayment terms. Cons: lengthy application process, strict eligibility requirements. 3. Business lines of credit. Description: a flexible loan that allows you to draw funds as needed up to a certain limit, similar to a credit card. Best for managing cash flow, covering short-term expenses. Pros: only pay interest on the amount used, flexible access to funds. Cons: variable interest rates, may require good credit. 4. Equipment loans. Description: loans specifically for purchasing business equipment. Best for businesses needing to buy or lease equipment. Pros: equipment itself often serves as collateral, preserving cash flow. Cons: limited to equipment purchases, potential for higher interest rates. 5. Invoice financing. Description: loans based on outstanding invoices, providing immediate cash flow. Best for businesses with long invoice cycles needing quick cash. Pros: quick access to funds, no need for collateral. Cons: fees can be high, may affect customer relationships. 6. Commercial real estate loans. Description: loans for purchasing or refinancing commercial property. Best for businesses looking to buy or refinance office space, warehouses, or other commercial properties. Pros: long repayment terms, potential for property appreciation. Cons: requires significant documentation, potential for high down payments. 7. Microloans. Description: small loans typically offered by nonprofit organizations or community lenders. Best for startups and small businesses needing smaller amounts of capital. Pros: easier to qualify for, supportive lending environment. Cons: smaller loan amounts, higher interest rates. 8. Merchant cash advances. SBA 504 loans. SBA 504 loans are designed to provide small businesses with long-term, fixed-rate financing for major fixed assets that promote business growth and job creation. Here are the key details. Purpose: SBA 504 loans can be used for purchasing existing buildings or land, constructing new facilities, purchasing long-term machinery and equipment, improving or modernizing land, streets, utilities, parking lots, and landscaping, renovating existing facilities. Loan structure: An SBA 504 loan typically involves three parties. Certified Development Company, CDC, a nonprofit corporation that promotes economic development. The CDC provides 40% of the loan amount. Third-party lender, usually a bank or credit union, which provides 50% of the loan amount. Borrower, the small business owner who contributes 10% of the loan amount. Loan amounts and terms. Maximum loan amount, up to $5.5 million for standard projects. Certain energy-efficient or manufacturing projects may qualify for higher amounts. Repayment terms, 10, 20, or 25 years, depending on the nature of the assets financed. Interest rates, fixed rates pegged to an increment above the current market rate for 10-year U.S. Treasury issues. Eligibility criteria. To qualify for an SBA 504 loan, a business must operate as a for-profit company in the U.S. or its territories. Have a tangible net worth of less than $15 million. Have an average net income of less than $5 million after federal income taxes for the 2 years preceding the application. Meet other general eligibility standards, including size guidelines, management expertise, a feasible business plan, good character, and the ability to repay the loan. Application process. Find a CDC. Locate a certified development company in your area to start the application process. Prepare documentation. Gather necessary documents, including financial statements, business plans, and personal financial information. Submit application. Work with the CDC to complete and submit the application to the SBA. Approval and funding. Once approved, the CDC and third-party lender will coordinate the disbursement of funds. Benefits. Fixed interest rates provides predictability in loan payments. Long repayment terms helps manage cash flow with extended repayment periods. Lower down payments typically requires only 10% down, preserving business capital. Limitations. Use restrictions. Cannot be used for working capital, inventory, or refinancing debt. Lengthy process. The application and approval process can be time-consuming. Collateral requirements. The assets being financed usually serve as collateral. SBA 504 loans are a valuable tool for small businesses looking to invest in significant assets and drive growth. If you need more specific details or assistance with the application process, reaching out to a local CDC can be a great next step. Would you like to know more about any other types of business loans or financial topics?